It is just the beginning of 2023, and the collapse of some major banks like Silvergate, Silicon Valley, Signature, First Republic, and even Credit Suisse is sending shockwaves through the financial world. Why is it such a big deal, and why is everyone talking about it? Listen up, folks, because this is a big one. Credit Suisse may not be a household name in the U.S., but if this bank goes bust, it could send shockwaves through the entire global economy. Why, you ask? Well, it's no ordinary bank. It's one of just 30 banks in the world with the title of Global Systemically Important Bank. These financial giants are so crucial that if one of them fails, it could trigger a financial meltdown of epic proportions. And if that happened, European banks could follow suit, sending ripples that could even reach the U.S. banking system. It's no wonder that the U.S. Treasury is on high alert, keeping a close eye on banks with any ties to Credit Suisse. The stakes are high. By now, most of you are probably wondering what you should do in this situation. Stay till the end to know the best way possible to protect your money in case your bank collapses. Silicon Valley Bank, the go-to lender for startups and businesses in the tech mecca, has just suffered one of the biggest bank failures in U.S. history. But what does this mean for the banking industry as a whole? Let's take a closer look. When you peel back the surface, you'll uncover a massive blind spot in the banking industry that's been hiding in plain sight. Enter Silicon Valley Bank, a powerhouse lender that's been fueling startups in the tech hub since 1982. It's the go-to spot for CEOs and businesses in need of funding, and for good reason. It's been a godsend for companies for the last 30 to 40 years. But in 2020, something seismic happened. Interest rates hit rock bottom. Want to see just how steep the drop was? Check out this graph that tracks the rate changes from January 2020 onwards. Stimulus measures flooded the economy with cash, leaving both banks and people swimming in dough. But here's where things get dicey. With everyone rushing to deposit their newfound wealth back into the banking system, the banks are suddenly stretched thin. You see, banks work on a fractional reserve system, where they're required to keep just 10% of their customers' cash on hand for withdrawals. This allows customers to assess a large pool of funds and earn interest on their deposits. Sounds great, right? Well, it all hinges on customers having faith in the system and not all pulling their money out at once. Unfortunately, that's exactly what's been happening lately. Yikes! Picture this. Silicon Valley Bank, a tech-savvy financial institution, decided to play it safe by investing billions in government treasuries. Sounds like a safe bet. They ended up playing a risky game of chance, betting that interest rates wouldn't rise too fast. Spoiler alert, they lost big time. With bonds valued based on yield, the bank was left with a hefty loss and struggling to keep up with customer withdrawals. So while they were banking on stability, they ended up facing a financial storm. Lesson learned? Even the savviest investors can get burned when they gamble with the market. In 2021 and 22, Silicon Valley Bank invested around $100 billion into government-backed bonds and fixed some of this investment for 3 to 4 years at an interest rate of just 1.79%. When it comes to banks, having enough capital to cover customer withdrawals is usually a no-brainer. But things get sticky when you throw in technology-based companies and the Silicon Valley Bank. See, these firms didn't get the usual funding they rely on, leaving them scrambling to cover their own expenses. And where do they turn? Yep, you guessed it, the bank. Suddenly, withdrawals were skyrocketing, and the bank was feeling the pinch. They misjudged the Federal Reserve's rate hikes and locked away too much of their money in one specific asset that produced a very low yield. This all happened at a time when customers began to withdraw hefty amounts of money, resulting in the downfall of the bank. They were failing to raise the funds to cover their losses, and had more withdrawals than cash on hand. The regulators ultimately decided to shut down Silicon Valley Bank. You might think your money is safe in the bank, but let's talk about FDIC insurance. Created after the Great Depression to restore faith in the banking system, it covers up to $250,000 of your deposits in the event of a bank failure. According to their website, a customer can get their deposits within a few days after a bank closes. But here's the catch. If you've got more than that in a bank, you're playing a risky game.
To work, because why would you take even 1% of risk keeping your money, or at least all of it, in a small regional bank? You're going to diversify. And I think that's the first lesson that wasn't being adhered to, is when you have liquid assets, you want to make sure it's diversified. And the rule we've put in place for our portfolio companies is no more than 20% in any one financial institution, because you never know where the black swan is swimming. In other words, every single institution has an idiot manager. Big ones, small ones, that's been proven by history. You just don't know where they are.
Take Silicon Valley Bank, for example. With only 15% of deposits under the FDIC limit, more than 85% of their customers' money was not insured. And if the worst happens, the bankruptcy court process can take years, with no guarantee that you'll get every penny back. This situation will be very traumatic for the companies and businesses that put money in Silicon Valley Bank, since they currently hold more than $342 billion worth of customer funds. So the question is, could the same thing happen to your bank? Well, it's technically possible, but highly unlikely. Imagine a bank that's a lifeline for startups and tech giants, but its funding is drying up. That's what happened to Silicon Valley Bank, and things went from bad to worse when customers started withdrawing their money faster than it was coming in. To make matters worse, the bank had locked up most of the capital in low-yield bonds, and those had lost value. While other banks keep 10% of customer funds on hand, Silicon Valley Bank went all in on bonds, just as they were ready to take a nosedive. It was a high-stakes gamble that didn't pay off, leaving the bank with no choice but to be shut down. Some other larger banks are also exposed, but it's highly unlikely they would be in a similar situation. In order to protect your money, you should always select a bank that is FDIC-insured and never keep more than $250,000 in a single account. You can have multiple accounts with other banks so that you have something to fall back on in the event of a bank failure. Sometimes things are meant to happen and are completely out of our control. Even if you take every step in the right direction, you never know what's coming your way. Will Silicon Valley Bank sink or swim? That's the million-dollar question as investors and customers hold their breath. While a government bailout or rescue by another bank could be in the cards, one thing's for sure. This situation highlights the dangers of bank locking up assets and leaving customers' money at the mercy of the Federal Reserve. It's time for more regulations to ensure proper diversification of deposits and prevent such high-risk gambles. The FDIC limit of $250,000 makes no sense for business accounts. While FDIC insurance is a lifesaver for individuals, it falls short of businesses with high overheads and costs. A percentage-based limit or higher cap would make more sense. Obviously, no real business would operate a $10 million bank account the same way an individual would. After all, running a multi-million-dollar business is a whole different ballgame. Do you think that FDIC limits should be according to the percentage of the deposited amount? I would love to hear your opinion in the comments. If you've reached this far and liked the video, subscribe to our channel. Also click the bell icon so that you never miss any future updates. Until then, take care.